Okay. Good morning. We are still in the morning. Good morning, everyone. And okay, afternoon. Good afternoon, everyone. Welcome to Next Gen Professional Associates. In today's class, we will look at another topic that is different from what we've been doing from the beginning of strategic financial management, and which is adjusted present value. And one thing about adjusted present value is that if you know it, you know it. And if you don't know it, you don't know it. All right. Then what you need to do in adjusted present value is that you need to understand risk adjusted cost of capital, because we will use risk adjusted cost of capital in this class. We will use it. So if you know you don't understand risk adjusted cost of capital, immediately after this class, just go to the YouTube, check risk adjusted cost of capital. Is there. Make sure you watch it and understand. Then you can now come back to this to adjusted present value. Now, class, the question now is, what is adjusted present value? What is it used for? Class, um, adjusted present value is like, we have a capital budget, right? There is a capital what? Budget that is mainly for investment, right? Now, there is an adjusted present value. What does this mean for? Capital budget consider all relevant cash inflow, right? Capital budget consider what? All relevant cash flow, right? Now, adjusted present value combines both both all the sources of finance. Plus, adjusted present value combines, contains, or include all the sources of finance. It does not say, oh, this is relevant, or it does not say this is not relevant, right? Now, what it does is to combine the two together, right? Both the one that is relevant for the project and also the one that is not relevant, right? So, adjusted present value consider all sources of finance. In summary, all what? All sources of finance. The capital budget or the capital investment, right, did not consider all sources of finance, right? This consider all sources of finance, the interest cost, the issue cost, the transaction cost, the this, the that, right? And that is why adjusted present value is different from what? Capital investment. Capital investment consider the relevant cash flow, does not consider all sources of finance, while this consider all sources of finance, everything. Now, if that is established, excuse me, the format, how do we determine the adjusted present value, which is APV? Just two things, two items. Class, adjusted present value is just two items. And these items are the base case NPV and the PV of financing effects. When you want to calculate adjusted present value, you need two. When you want to calculate adjusted present value, you need two items. One, the base case NPV, the PV of financing effects. You need these two to determine what? The APV. Class, the question now is, what is base case NPV? That is the question we should ask ourselves. What is the base case NPV? And this will take us to Modigliani and Miller assumption. Now, what's Aisha, please mute your mic. This will take us to the base case NPV assumed that the project will be financed only by equity. And this will take us to the Modigliani and Miller assumption. One of the assumptions is that a project will only be financed by equity. Now, the base case NPV, in calculating base case NPV, use ungeared cost of equity, which is the POSI company, for the discount rate. Class, the base case NPV simply means that a project will be financed by equity. By what? By equity. Now, when you want to discount a base case NPV, you use what? The ungeared cost of capital, so our cost of equity of the POSI company to discount the project. Now, in calculating the base case NPV, right? What are the steps in calculating the ungeared cost of equity? Why do you have to use ungeared cost of equity to discount the project? Sorry, a minute. Sorry. Now, I purposely I just want the class to be calm, right? So that you will have both the theory aspects, understanding of adjusted present value, as well as the practical approach. Now, when why do you say why do we have to discount the project with the ungeared cost of equity? It is assumed that you will only finance your business with equity. That is the assumption. Now, how do we determine the ungeared cost of equity? Don't forget our steps under the risk adjusted cost of capital. Don't forget when they say ungeared, it is the POSI company. Now, the first thing you need to do, we want to determine the ungeared cost of equity that we will use to discount the project. First thing you need to do, one, is to identify the POSI company, which we've done that under the risk adjusted present value. Number two is to determine the better assets of the POSI company, right? The better assets of the what? Of the POSI company. Now, if you want to determine the asset better, and this is the formula, which we've done that under what? Under the risk adjusted cost of capital. You can see when beta debt is equal to 0, your BA will be equals to BE times VE divided. So all these things are, all these variables, all these items are for what?
Sir, please, are you sharing your screen? I cannot see your screen.
Yes, I'm sharing my screen. Please, others should confirm if they can see my screen. It could be your network.
I can't, sir.
Okay. You can see it. So maybe just use other network, right? Just change. You can just change your network, please. Thank you. Okay, you can see it. Okay, that's fine. So when you want to determine that the better asset, and this is what you will use to determine the better asset. But after calculating the better assets, under the risk adjusted cost of capital, you expect it is expected to do what? To regear under the risk adjusted cost of capital. But in this case, you don't have to regear. Do you know why? Because you want to determine the cost of equity of the ungeared company. ungeared company, which is the proxy company. So you don't need any elements of the main company. You don't need it. That is why the next step is to use the beta asset to calculate the cost of equity. So it is assumed that the equity beta, the asset beta is still the same thing as what? The equity beta. Class. Use the beta assets to calculate the what? The cost of equity. It is assumed that is CAPM. So the BE will becomes what? Well, will becomes the asset beta. Then you will now calculate your cost of equity of the what? Of the ungeared company that you will use to discount your base case NPV. Your base case NPV, your NPV is your normal NPV format. It is your normal NPV format. It is the normal cash flow, cash inflow, cash minus this. But the DCF that you will use to discount the project is ungeared cost of equity. It is assumed that the company will only be financed by what? By equity. That is the law. It is assumed that the business will be financed by what? Equity, which is not possible, right? In real life situation, it is not possible. At least you will have small what? Some little debt, right? So this is the steps to determine the ungeared cost of equity when you want to determine the base case NPV. You want to determine the NPV. What you will use to discount the project, right? You use what? You use ungeared cost of equity. It is assumed that the business will be financed only by what? By equity. Now, it depends on what is given to you in the question. Now, the other one that the first step is allowed. It depends on what is given to you in the question. Alternatively, that will now take us to Modigliani and Miller assumption. There are two prepositions. There is preposition 1 and there is preposition 2. I don't want to go to preposition 1 because it is assumed that you will finance it by equity and debt. But preposition 2, and this is the formula, right, showing on my screen. This is the formula for calculating the what? The cost of equity of the ungeared what? Of the ungeared company. Class. Now, class, it depends on what is given to you in the question. Or you can state, if you want to test, if you want to show, if you want to, if you want to like show yourself, you can test it. You use the first one, which is the steps, then you use the alternative. But watch out for these two. Depends on what is given to you in the question. Now, the formula here is what? The cost of equity of the geared company equals to the cost of equity of the ungeared company plus the cost of equity of the ungeared company. Ungeared company, don't be ungeared company. It is a positive company. Minus the cost of debt, right, of the ungeared company, the market value, the market value of debt divided by the market value of equity, 1 minus t. Excuse me. All this is for the what? The proxy company, cost of debt, the cost of. Now, the question now is, what did you want to achieve from this formula? You want to determine the cost of equity of the ungeared company, which is KEU. You have to use M and M, which is the Modigliani and Miller preposition what? Preposition 2. And this is the formula. Now, which means that the cost of equity, you want to determine KE, which is this. That is what you want to do because you want to determine the cost of equity of the ungeared company. Now, when you want to determine the cost of equity of the ungeared company, you have to make this the subject of the formula, which means that the cost of equity of the geared company will be given to you in the question. The cost of equity of the ungeared company will not be given to you, which you are looking for. The cost of debt will be given to you for the ungeared company, which is the proxy company. The market value of debt of the proxy company will be given to you. The market value of equity will be given to you. The tax will be given to you in the question. For you, it's just for you to make this the subject of the formula. Let S represent the KEU, right? So when you make it the subject of the formula, you get your what? You get your cost of equity of the ungeared company that you will use to discount your base case NPV. So you have two options. The first option is this, and the second option this. So is the in the question, you have to observe it very well that which one of these am I using? And however, you can decide that, oh, if option one can work for you, they give you all the variables you need, of which we'll look at that. They give you all the variables you need. You go for option one. Alternatively, you could say, oh, if the cost of equity of the geared company is given to me, equals to is given to me, I need to make cost of equity of the ungeared company the subject of the formula, then the market value of debt, right, divided by the market value of equity of the ungeared company, which is the proxy company, and 1 minus t, right? It is assumed that what it will be financed by what? By equity. And don't forget Modigliani and Miller assumption that there is no transaction cost, there is no taxation, there is no this, there is no that, right? Now, and this is what you need to know when you want to determine the base case NPV. And it is just like this. This is, we don't need it, but I just needed to bring in the preposition one so that you see, you look at it, and this is just the preposition one. We don't need it in our just the present value. What we need is the preposition two, and which is this class. We don't need it. I just needed to bring it out so that you will see that this is preposition what? Preposition one, and this is preposition two. You are using preposition two, or you look for the formula if all this variable is given to you, or you can decide to use this or the alternative using what? Modigliani. And this is all about what? Base case NPV. That is all. The major problem is, what do you use to discount? It is still your normal NPV, but what you will use to discount it is the ungeared cost of equity. Why? Because it is assumed that the business will be financed only by equity, right? Either you use these steps or you use what? The Modigliani and Miller preposition what? Preposition two. That is base case NPV. Don't forget, when you want to determine adjusted present value, you have the base case NPV and the PV of financing effect. The base case NPV is calculated using the normal cash flow and cash inflow. But what you will use to discount it is what? The cost of equity of the ungeared company, which is what? The proxy company, right? Now, you use Modigliani and Miller preposition two, or you follow these steps, of which we will look at these two, right? We'll look at these two in this in our illustrations. Now, another thing is the PV of financing effect. You can see you're only looking for two items, but you have to do a lot of calculations, right? The base case NPV will be there. Then now the PV of financing effect. That is the all sources of finance we are talking about. All sources of finance, right? Both the equity and what? And debt. Now we move to all what? We move to the PV of what? We move to the PV of financing effect, right? We move to what? The PV of what? Of financing effect. We have examined the base case NPV. Now, the PV of financing effect. Now, this is how you need to structure your PV of financing effect class. This is how you need to what? Structure it. Don't forget, adjusted present value consider all sources of finance, right? All sources of finance, the interest, the comma, everything you have to take into consideration. And you just need two items. One, the base case NPV and the PV of financing effect. The two, addition or subtraction of two, will give you what? Will give you adjusted present value. Then you can now say, oh, is it positive Or is it negative? If it is positive, you say, oh, they should go ahead. If it is negative, you say no. It means it will not be viable, right? And that is it. And that is it, right? Now, Aishat may be looking at, oh, you want to embark on a project, you need to consider all the sources of finance, and this project is very important. You need to look at looking at the government, looking at the subsidies, looking at a lot of loans for you to finance this, looking at equity. Maybe you want to raise, you want to do right issue. During the time of CBN recapitalization, you see a lot of banks going into the market to do a right issue below the market price, and also issuing a bonus below the market price to their what? To their existing shareholders. We see a lot of things that play out in the market then. And that is what we are trying to say here. What is the cost, right? Don't forget that Modigliani and Miller is saying that there is no transaction cost. It is a very big lie, class. When you say it is an assumption, so the theory is just trying to say that they are not trying to say the assumption will work, right? It is not that the assumption will work, class. It is not that the assumption will work in real life, but they are just trying to test it. Is it possible that there is no transaction cost? It's a very big lie. Do you know why? You buy one of the bank shares. When you buy one of the bank shares, in the process, there is what we call transaction cost. Now, and broker, there is what we call, there are some guys that are called brokers, right? Maybe I don't want to mention name, right? Because they are not they are not paying for advert, right? So one of them, let me just mention one of them. Let's say Vertiva, for instance, is one of the stockbroker, right? And you decide that you buy a shares through Vertiva. Now, in the process, they will charge you. There is a commission cost there, maybe about, I think, 1 point something, 1.3% the last time I checked, right? So it's part of when you want to withdraw. Let's say you now see that, oh, Gitco Bank shares increase. You decide as a rational investor, right? You quickly go to the market, you take your investment because you see that there's an increase in the market price. Now, in the process, instead of you to get like 50,000 naira, you will not get 50,000 naira because you have to pay for a transaction cost. So with that, you are doing what? You are incurring a cost. So it is a very big lie that there is no transaction cost and there is no taxation. Is it possible that there is no taxation? Right? The dividend you receive, it is a net of withholding tax. It is a what? And there is no taxation. The company you collect the dividend from, they pay tax, right? Directly or indirectly, you are also paying what? Tax. So I don't want to go into the assumption, but I just want you all to understand that this is how it works in real life, right? Now, the PV of financing effects. Use the commercial debt rate. Use the commercial rate to discount. When you want to discount, this is a debt. Class, this is a what? This is a debt. Then when you want to discount it, you use what? The commercial rate. The commercial rate to what? To discount. The question now is, what is commercial rate? Now, I will divide it into like three sets. There's what we call commercial rate, cheap rate, or okay, commercial loan, cheap loan, or subsidized loan. Commercial rate. When you go to bank now, they will tell you back that the interest rate is 30% because the MPR has been rebased based on the inflation, and it has actually affected. They've decided that, oh, MPR now is about 27.7%. Is that also? Now, if it is 27.7%, definitely inflation, definitely bank will be lending at, will not lend at 27.7%, maybe probably at the basis point of 30%. Right? Now, if it is at the basis point of 30%, you go to a bank, you want to borrow money. Is that also at 30%? That is the commercial rate. Now, the government is now doing that, or government is now saying that, okay, since you want to finance, you want to go into agriculture, let's give you a subsidized rate. let's give you a subsidized rate of maybe 10% below. Let me use that language because you will see it often and often time in adjusted present value. Say percent below the commercial rate. If they say 10% below the commercial rate, that is 20%. 10% below the commercial rate of 30%. That is 20%. Now, government is trying to say they want to subsidize it for 20%, and the commercial rate is 30%. Is that not so? So you use the commercial rate to do what? To discount the what? The product, because it's the sources of what? It's the sources of finance. Now, if this is established, there's what we call issue cost. Now, you want to finance a business, right? I've mentioned it, unlike a transaction cost, right? Now, equity now, right issue, for instance, you issue a right issue to the general public, right? It is a cost to you, to the firm. It is a return to the what? To the investor. Now, you as a company, there is a cost on it because you pay back. There's no obligation, but you pay back, right? Now, that cost is what we call issue costs, right? Or issue cost could be a transaction cost. You use Vertiva as a broker, for instance, right? In the process of withdrawing your funds, there is a transaction cost. That is issue cost. Now, equity. Now, and this issue cost, we assume to start from year zero because we have not started the project. We assume to start from what? Year zero. That is what issue costs, right? Now, another thing is the issue cost on debt, both equity and debt. Of course, right? Of course, we have, if you check debt management portal, we have some people who are in charge of that, right? Probably Stanbic IBTC, you want to buy bond, right? Debt instruments. In the process, you have to pay. You have to pay an issue cost, class. So it is assumed that the project is yet to start. So it is at year zero. Then the DCF you will use to discount is the commercial rates because it is a financing effect. It's considered all sources of what? Finance. Now, the next thing is tax savings on issue costs. Class, tax savings on issue costs. There is always a tax relief on debt. There is always a what? Tax relief on debt to the what? To the company. So tax savings on issue costs. What will be the tax savings on debt? For instance, if the tax rate is 30%, the issue cost is 50 naira, right? It will be 30% of the 50 naira. Will give you the savings of that, class. Now, why do we have to put it in year one? Because it is assumed that year zero you borrow you borrow funds. Year two, year one, of course, for you to have the tax savings, you've started using the funds. Then that is why you say tax savings on issue cost will always start what? Year one. Tax savings, you have 30%. Please pay attention. You have 30%, and the issue cost on the debt is 50,000. So 30% of this will give you the tax savings on issue cost, and it will becomes an inflow to you. It will becomes an inflow because it is tax savings. It is a relief that the relevant tax authority will grant to you, right? Will grant to you because it is a relief, right? Now, there is always a problem here. Tax savings on issue costs, in some questions, right? It may be silent that they may not even talk about the tax savings on issue costs. It may be what? It may be silent. If it is not mentioned, right? It is not, if it is not mentioned, but sometimes they may actually mention it. But if it is not mentioned, it is assumed that sometimes you may have tax savings on debt, and also tax savings on what? On equity. It depends on what the question says. Let me repeat this. Sometimes question may tell you that there is a tax savings. There will be a tax savings on both debt and what? And equity. But if it is just mentioned that tax savings is on debt, you know it is only on what? On debt. If it is silent, you just use debt and you move on. Now, another thing is tax savings on interest cost. What is tax savings on interest cost, class? That year two that I actually put there, you can erase it. Why? Oh, this call will end in 3 minutes. Sorry. Omo. Okay, because the lecture is actually okay, let me where are we? Okay, we are in tax savings on interest cost. Class. Tax savings on interest cost. Uh Commercial rate in bank maybe 30%. Subsidized loan, subsidized loan is 20%. Or subsidized loan, let me use that language again. Right? Is 30% below, is 30 basis points below the market, below the NPR, below the what? The commercial rates. 30% below. 30 basis points. Let me use that word. 30 basis points below the commercial rate. And the commercial rate is 30. It is 10 basis points below. That is 20%. The 20% is the interest rate, right? Then the other commercial of 30% is also what? Interest rates. So what is the interest rate for both commercial and what? And the subsidized. So interest rate on what? On the original amount borrowed. Interest will be on the original amount borrowed on the commercial. Interest will be on the amount borrowed on the subsidized, on the total amount borrowed, the gross amount, right? So when you charge, it's just like you borrow 50,000, the interest rate is 20, you borrow another 20,000, the interest rate is 10%. What is the interest rate? Then, what will be the tax savings? Charge tax on it. What will be the tax savings? Now, in every question, you will be told that the company paid interest in arrears, or the tax is in arrears, right? You may be told that, oh, the tax is in arrears, or the tax occurred, the tax is being paid in the year in which what the profit realized, or they will just give you an what is it called? An instance like that, right? But we'll get there. So now, what I'm trying to explain here is that you borrow 50,000, right? You borrow 50,000, your interest will be on the 50,000 as well as what? As well as the commercial, the subsidized, as well as what? Another name for subsidized loan is what we call cheap loan, cheap loan, cheap loan, cheap loan, right? We'll get there. Now, under the commercial is you borrow 20,000, interest rate is 30 times 20. The other one is what? The other one could be 10,000. What is the interest rate? Maybe the interest rate is 10, right? If the interest rate is 10, right? When you charge it, what do you have? We'll give you the interest what? Interest portion. Charge tax saving. There will be a tax savings on that what? On the interest, right? Now, how will you do it? Is it from year 1 to year 4 or from year 4 to year 5? We'll get there. It depends on the question. I just put that 2 years there, right? Now, another thing is savings on interest. Now, I will use a practical illustration. Yes, savings on interest is like um Moses Mr. Moses and Pemisire, for instance, okay, so don't let me use that. You have a commercial rate of 5%, you have a subsidized rate of 2%. What is the difference? The difference is 3 minus 2, that is 1%. You have you have an option. You look at it. What is your savings? You have commercial rate of 20%. You have subsidized rate of 10%. So instead of you going for the commercial, what is your savings? How many percent did you save? That is the 20% minus what? Minus the 30% minus what? Minus the 10% will give you savings. The savings interest. How much do you save? Interest times what did you save it on? You save it on what? On what is it called? On the subsidized. That is what you save it on. We will get there. So I'm just pushing this. I'm just explaining it the way it is, right, class? Savings on interest. It means that um you have a commercial rate. Let's say you have a commercial rate of 30%. Then you have a subsidized rate. Excuse me. You have a subsidized rate of 10%. How many percent did you save? 30 minus 10. 30 minus 10. That is what? That is 20%. Where did you save it? We need to multiply it by something. Is that also either commercial or subsidized? We will get there. Right? Now, tax paid, savings on interest, it becomes an inflow to you. Tax paid on interest saved. Of course, you've already saved interest. You've saved, you pay tax on that what? On that interest. So when you are paying tax on the interest saved, right, it becomes an outflow to you. It's an outflow. You already save out of 30%, you save 20%. That's if you pay tax on it. Is that also? Don't forget, don't forget that don't forget that in the profit or loss account, you have profit after tax, profit before interest and tax, and profit after profit before tax, right? Before you now apply tax. Is that not so? Now, tax paid on what? On interest. So the tax you paid on the interest will becomes an outflow. Tax saved on interest will becomes what? An outflow. So with this, now, with this, you have your PV of financing effects. Then when you have your PV of financing effects, so you combine the base case NPV and the PV of financing effect. The two will give what we call what? Adjusted what? Adjusted present value. And this is all you need to know under what? Under adjusted present value, right? This is all you need to know under what? Under adjusted what? Adjusted present value. So if you have question for me, you can unmute your mic and ask your question before we look at an illustration to this. Okay,
Good
Mr.
afternoon,
Moses.
sir.
Good afternoon.
It's calling from Port Harcourt. Sir, please,
Okay.
when they say that the issue cost is on gross or on net, please, I just want you to explain little about this.
Okay, that's fine. Interesting. Noted. Do you have any other question? Okay,
No,
favor.
sir.
Okay, that's fine. So let me quickly
Hello,
put down something.
hello, sir.
Okay, please go ahead. I want to put down something.
Please
Please go
explain,
ahead.
shed more light on the get company and also the unget company.
I should do what? No. Wait,
Shed
I
more
should
light
do
on
what?
the get company and unget company.
I should explain it.
Yes, sir.
Like, I should explain it in the sense that you don't know, like, I just want to understand something, no, in favor. I should explain the on get company and get company.
Get company. Yes, the cost of equity of the get company, the KEG and the KE.
Okay. Don't forget it's an assumption. No. Okay. Now, let me start from Mr. Moses. Or let me start from Favor. Favor. This is on get cost of capital or cost of equity. This is the formula. Now, this formula here is an assumption. And it is what it is. So the only thing I will explain here is that the cost of equity of the ungeared company is the proxy company. Ungeared company is the proxy company. So you want to determine the cost of equity of the ungeared company, you can use X, the subject of the formula. This KD is the cost of debt of the ungeared company, which is the proxy company. D, market value of debt of the proxy company. E, the market value of equity of the proxy company, 1 minus T. It is an assumption of what? Modigliani and Miller preposition 2. So it is assumed that you have cost of equity of the geared company equals to the cost of equity of the ungeared. Then the ungeared is the proxy company. So, Favor, have I answered your question? Favor.
Yes, sir. Thank you, sir.
Okay. Now, Mr.
Thank
Moses.
you, sir. Yes, sir.
Okay. Now, Mr. Moses, your question,
Yes, sir.
that's a very good one. But we should also pay attention to every question, right? It's very important, right? Is what is very important. If the issue costs,
I asked the question.
I'm coming.
I try looking at one. Okay, sir.
I'm coming. Now, if the question says that you have two options there, if the question says that the issue cost is on net, which means that it is the question that tell you that the issue cost is on net, right? Now, if the issue cost is on net, you charge that percentage on that amount, which means that net means that they've considered issue cost. Now, if the issue cost is on gross, we'll get it. On gross means that so don't forget that in adjusted present value, when you have the debt is 50 naira, that debt that you borrowed, the money you borrow of 50,000 naira, right, is a net class. The right issue that companies want to raise from the market is like a net amount, right? Now, because issue cost might have been taken into consideration, the transaction cost that they will incur in the process, they would have put it inside, right? For them to say right issue below this. I'm giving an instance other equity. Now, if that would be the case, that is net. For you to get the issue cost, which is the cost of that debt, right? You have to gross it up. So once you gross it, you have your gross amount. Gross means that the net plus the issue cost. You gross it, you have your gross amount. Gross amount means that we have not considered issue cost. That is the real amount. Is that not so? We have not removed issue cost, right? We have not removed issue cost, but it is issue cost is inclusive. I don't want to go into that side until when we see a question. I have 1, 2, 3, 4 questions under the adjusted present value. We will examine 3 of these 4 questions. By the time we examine 3 of these questions, you will see a cases whereby you will have issue cost is on net amount, issue cost is on gross amount. By then, you will have a better understanding on how to treat both on the what? On the net amount as well as what? As well as on the gross amount. Mr. Moses.
Yes, sir. Thank you very much. And where the examiner is silent on whether it's gross or net, do we assume
No.
it to be gross or net? As in, examiner is silent on that.
No,
What do we
examiner
do?
will not. I've not seen a question like that. That examiner is silent whether you should use the issue cost is on gross on the net amount. They will always state something they will tell you that okay, the issue cost is this. Now we'll look at it. Maybe from this question I will still check again because I just look at the question. I feel that oh, I'm good with this question, right? So we'll look at it if there will be, when we have four questions. From there, we can now say, oh, what if examiner is silent? I've given an instance. Oh, what if examiner is not silent? But most times they will tell you that issue cost is this, issue cost is that. Mr. Moses, we'll get there.
It's okay. Thank you very much, sir.
Yeah. Don't worry about that. We'll know how to treat it when we get to that part. Any other question, please? If any other question, and this is what we need to do under the adjusted present value, you need to understand the steps. Okay.
Please, sir, can you please explain the concept of commercial rates? Sorry.
Wow. Have you been in this class? Or your network?
My
Rachel?
network was fluctuating.
Yeah, that's why. I think so. I've been
My network
screen.
has been fluctuating.
Yes, yes, yes. I've been giving an illustration to that, right? Commercial rate is like the MPR now is the interest rate now is from the CBN is 27.7%. Now, when bank want to lend, may lend at the rate of 30%. That 30% is what we call commercial rate. That is the lending rate. Rachel?
Okay, sir, understood. Thank you, sir.
No, okay. So, any other question, please? So, are we good? Okay. I think I have one question. So, we'll solve one today, then the other one will solve it in our next class. Okay. Okay, illustration one. Illustration one. So we have to analyze this question, right? Then we will also apply the what? The principle. We also do what? We also apply the principle, right? Okay. PH is well diversified risk-taking PLC. Is a well diversified risk-seeking PLC. Is a well diversified risk-seeking PLC. It has target debt to assets ratio, which is debt, that is debt to equity plus debt of 25%. Class, if you have debt to asset ratio of this, debt divided by equity plus debt, how many percent is debt and how many percent is equity? Please unmute your mic. If you have debt to asset ratio of debt divided by equity plus debt of 25%, how many percent is debt and how many percent is equity?
Debt is 25,
And
equity is
75.
75.
Yeah.
Okay, that's fine. Please, did you agree with Madam Linda and Mr. Moses?
No, I didn't get it.
I agree.
I didn't get it, please.
That that is 25%. Equity is 75%.
Okay. Please, did you agree with okay, Aishat?
Yes, agreed.
Aishat, unmute your mic quickly.
All right, sir. I understand that debt is 25% and equity is 75%. But I think that I've seen in a scenario whereby they did a question, they did equity to be 1%, that's 100%, and equity was about 25%. So I don't understand what instance are we going to assume that assumption, sir?
It is not an assumption. It is what it is. I believe that Aisha, you joined this class. Okay, you didn't join us. Did you join? Were you in class when we treat risk adjusted cost of capital? I guess no.
No,
No.
sir.
Okay, that's why. That is why. Now, the D over, see, go and check what they did. That is why I normally tell professional students that, see, that's their solution. Is still subject to review. Now, you have debt divided by equity plus debt. What it means is that debt is 25%, equity is 75%. The only way around, when you have debt over equity, let's say debt over equity of 1%. 1% means 100% is 100. Let's say is 100. 1% means 100. Debt over equity. Is that also debt over what? Debt over equity is what? Is 100%. What it means is that it's 100%. Debt is 100. Equity is what? Is 100. Now, if you have debt over equity of 25%, debt over equity of 25%, debt over equity. Debt is 25%, equity is what? 100%. So you can see the instance, Aisha.
Yes,
Permissive.
yes, I got it.
Okay, 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 that's fine. So let's continue with this question. Okay, now an equity beta of 2.5. So the company is well diversified risk seeking PLC. The equity beta, this is the equity beta of 25% of 2.25%. Now I want to ask another question now. When equity beta is 2.25%, what does this imply to the company? When an equity beta of a company is 2.25%, what is the implication? Who can tell me? What is the implication?
It's higher than the market.
According to your
It is
definition,
highly
exclusive.
It is
I
highly
said
geared.
it is 2.25 riskier than the market.
Okay, no problem. What? Interesting. It makes sense. Abdurrahman,
I said it means the company is highly geared.
geared under equity. Mm, geared under equity. Okay, okay, that's fine. Now, when equity beta is this, I've explained in I think even under in portfolio theory, for those of you who have watched the pre-recorded video, I've been mention of equity beta when it is greater than 1, when it is less than 1. What it means is that the company shares is risky, and a risky investor, a risk tolerance investors may decide to go for that kind of shares because their equity beta is greater than 1. It's risky because, and again, when it is like that, the higher the risk, the higher the return, right? Which means that the company stocks they have an high risk, right? When it is lower, they don't have the risk, right? The risk adverse investor may decide that, oh, I want to go for these shares. And when you are going for that particular stock, you should know that your return will be lower because the risk is minimal. Now, and pre-tax cost of debt, which means that this is the pre-tax cost of debt. They've not considered what? They've not considered tax. all this, they are still talking about the company, right? They are still talking about what? The company. The company is considering the purchase of a new machine. And the company is saying that, oh, we want to purchase new machine costing 600 what? 600 million, which would enable it to diversify. Can you see? Which will enable it to diversify. No, now, since they just mentioned diversification, something should comes to your mind. Definitely, there will be an ungeared company. There will be a proxy company. Is that not so? Now, which will enable the company to do what? To diversify. The machine would have 3-year life. The useful life of the machine is 3 years, after which it would have no residual value. It means that after the end of the 3 years, right, no residual value. The residual value will be what? Nil. The machine would generate profit before tax, net cash flow. So there is a net cash flow already on this machine. What the machine will generate. It is before tax of 260 million a year. And the machine lifespan is for 3 years. The supplier of the machine, the supplier of the machine is willing to lend PH. They want to lend PH half of the capital at a rate of 3%. Class. Finance. Excuse me. The machine cost is 600 million. The supplier is now saying that, oh, we want to help you. We will give you a loan that you will pay interest at 3%. What is the half of 600? Half of 600 is 300. Is that also? Is 300. Which means that the machine cost is 600. The supplier will give half 300. What about the remaining 300? What will happen to it? Where will they source for it? The remainder will be financed equally by debt and equity. Class. The remaining 300 will be financed equally by debt and equity. So that is 300 divided by 2. That is 150 will be for equity and 150 will be for debt. Class, are we getting the gist? Hello, class.
Yes, sir.
Okay.
Please, I'm lost. Please, I'm lost. That 300, where is it coming from?
Okay. But you are still in this class.
I'm with you. I'm with you. I'm with you, sir.
Please pay attention. The supplier of the machine is willing to lend PH half of the capital. And the machine cost is 600. If they lend them half of it, half of 600, is it not 300? It's 300.
Yes, it is. It's 300.
Then the balance, which is 300, will be financed equally by debt and equity. So the balance of the 300 will not be shared between the debt and equity, which is 300 divided by 2, 150. The issue costs
I understand.
on the commercial debt, the issue costs Please mute your mic. The issue cost on the commercial debt will be 1%. The issue cost on the commercial debt will be what? Will be 1%. Class, which one of these debts now is now the commercial debt? Is now which one of this is commercial? Now, the supplier is saying that we will lend you half, pay us 3%. The remaining one will be financed by equity and debt, which is 300. Divided by 2, 150. 150 for debt, 150 for equity. Now, the issue cost on commercial debt will be 1%, and the equity issue will incur cost of 3%. You can see now, from there now, you would have seen that the commercial debt now is in between the debt, the finance equally, which is the debt and equity. So, the commercial debt is this debt here that will be financed equally. 1% of it will be the issue cost, while the issue cost for equity will be 3%. All issue costs are on the gross amount raised for the respective capital. All issued costs are on the what? On the gross amount. Now, what it means is that when all issue costs are on the gross amount, it means that the amount we are giving to you is on the net, amount. The net amount. We give you 500,000. What we are giving you is net amount. Net amount means that we have deduct issue costs. We'll get there. Now, all issue costs are on the gross amount raised for the respective what? Capital. Right? A firm that's already in the trade of the new project, a firm that is already in the trade of the new project has a gearing ratio of debt to assets. Debt to assets of what? 20%. Is that not so, class? Debt to assets of what? Debt to assets of what? 20%. Class, are we still together? Hello, unmute your mic.
Yes, I know.
Yes,
Sir.
yes, sir.
Oh, you get it. You get it. You get it. It's like that. It's always like that. Adjusted present value?
Yes, sir.
Okay, that's fine. That's fine. Okay. A firm that is already in the trade of the new projects. A firm that is already in the new projects. We have what? Debt to assets. You can see this debt to asset gearing was not defined that, is it debt to over, like the way they defined the first one. So this is debt to asset is debt to equity. Since they didn't define it, it will be debt over equity, which means that debt will be 20 and equity will be what? 100. It is not defined. It is debt to equity. It is debt to assets. I didn't mean they defined it like this from the first, like the PH. Now you can see that a firm that is already in the trade of there is a proxy company now, and the gearing of the proxy company is 20% debt to asset. That is debt to equity, since it is not defined. 20% for debt and 100% for equity. And cost of equity of what? 18.1%. That is the cost of equity of that proxy company. And the cost of equity of what? 18.1%. Class, its corporate debt is risk-free. What is corporate debt? Corporate debt means commercial debt. Class, corporate debt means what? Commercial debt. Corporate. Now, its corporate debt is risk-free. What it means is that if the interest rate for commercial debt is 5%, the interest rate for risk-free will be 5%. That is what it means. Its corporate debt is risk-free. So any figure, any percentage, the interest for the commercial will still be the same thing for risk-free.
Sorry, sir, I didn't get that correctly, sir. Sorry.
You will get it when we start to solve questions. A government grant of 10%, a government grant of 10% of the initial costs, of the initial capital cost of the machine is available. Can you see it? There is a government grant. The first one is its corporate debt is risk-free. Any percentage, any interest for commercial debt, if the commercial debt interest rate is 5%, the risk-free will be 5%. That is what it means. If the risk-free is 10%, the commercial debt, which is commercial rate, will be 10%. That is what it means. A government grant of 10% of the initial capital cost of the machine is available. What it means is that government want to give grants. And what is this grant? If government want to give this company grants now, it will be an inflow because they want to give them grants. They did not want to borrow them or anything. They don't want to give them, they don't have any loan to give them. But what they want to do to them is that, oh, we will give you 10% of the initial capital. What is the initial capital of the machine? It's 600 million. We'll give you as grant. That grant will become an inflow to the company. Class, are we following? Are we following?
Yes, sir.
Yes.
Now, it is estimated that the grant will be received at the beginning of year 2. It is estimated that the grant will be what? Will be received at the beginning of year 2. I know most students will quickly go and put this grant in year 2. And the interpretation will now like, Shebi is at the beginning of year 2. Well, year 2 is at the beginning. Class, if you see this question now, this the part of it is estimated that the grant will be received at the beginning of year 2. You will go and put it in year 2 now. Is that not so? That since grant is year 2, we just put the grant there, right? It is not so. It is not like that, right? Now, if you want to put a grant at the beginning of year 2, definitely it would have been a closing balance. It would have been a closing in year 1. So when you want it to be at the beginning of year 2, it will be a closing balance in year 1. So you will not go and put the 10% in year 2. Class, let me repeat this again. It is estimated that the grant will be received at the beginning of year 2. So if you want to receive this grant at the beginning of year 2, definitely it would have been the closing. You would have included it in what? In year 1. So that you will receive it at the beginning of year 2. That is what it means, so class. Am I communicating?
Yes, sir.
Yes, sir.
Okay. Now, tax rates is 30% payable on 1 year in arrears, which means that year 1 will be paid in year 2, year 2 will be paid in year 3. Straight line depreciation. Straight line depreciation on the net cost of the machine. Straight line depreciation on the net cost of the machine after deducting the grant, it's tax allowable. Class, if you want to determine the depreciation, is on straight line depreciation on the what? On the net cost. When you want to, depreciation is granted, capital allowance is granted in lieu of depreciation. Is that not so? So that depreciation amount, it is a tax allowable. It's like a capital allowance. So, therefore, when you want to determine in this part, the straight line depreciation on the net cost of the machine after the deduction of grants, which means that the depreciation will be like 600 million minus the grant is tax allowable. And don't forget, it means that depreciation is allowable for tax, right? What it means is that the depreciation represents the capital allowance. Class. Now, the risk-free rate is 4%. The risk-free rate is what? Is 4%. Class. The risk-free rate is what? Is 4%. And the market return, the market risk premium is what? 7%. Don't forget, in this part of the question, we were told that its corporate debt is risk-free, which means that if risk-free is 4%, the interest rate on the commercial debt will be 4%. That is what it means. Class, the risk-free rate is 4%. Now, if the risk-free rate is 4%, and they say its corporate debt is risk-free, which means that if risk-free is 4%, the commercial debt rate, the commercial debt interest rate will be 4%. And don't forget, commercial rate is always higher at every given in time. And we're given market return, market risk premium of 7%. That is premium of what? 7%. You are required to estimate the APV of the proposed project. Class, we must complete this question today, right? You are required to estimate the what? The APV of the proposed what? Project. So class, are we good now? Can we start? Okay. Now, what is the first step? We need to do what? We need to calculate the base case NPV, right? That is the first step. Then when you are to determine the base case NPV is your normal NPV for the main company, for the company, your normal NPV, right? And what you will use to discount it is the cost of equity of the ungeared company. Now, we have two options. Either we go by our normal routine option or we use the Modigliani and Miller assumption, right? So we will use we will use both, then we will see it together. Class, this call will end in 6 minutes. Please, when it is 3 minutes, let me know. Favor, please, when it is 3 minutes, let me know, please, so that I can create another. Thank you. So suggested solution. Right? Suggested solution. So we are starting with the base case NPV. Base case NPV, right? What is the name of the company? We can put it as we can just put it as PH.
Yes.
PLC. Please make sure you are with your writing material, right? PHPLC. Now, this is PHPLC. We have to determine the base case NPV first, right? Base case NPV. So before we can determine base case NPV, we need to, before we determine the basic case NPV is not an issue for the main company. It's not a problem. But we have to look at for our relevant cash flow. Which one of these did they give us as part of our relevant cash flow? Then we will now look at what we use to discount the project. Now let's quickly go back. We can screenshot the question so that will not be, although I will send the question maybe tomorrow, right? Or today I'll send it. Now, class, there's a place that they mentioned that the machine cash flow will generate. This is what the machine will generate for the company. The machine will generate estimated before tax net cash inflow of 2C. See, the base case NPV is your normal cash inflow and cash outflow. But the only thing that will be different is what you use to discount it. Class. Now, we were given that the cash flow here will generate this. And what is the cost of the asset? Excuse me. The cost of the asset is what? 600 million. This is the cost of the asset. We are picking it one after the other. Yes, 0. Right? And it will give net cash flow, which means they've removed their cost a year, right? And the machine will last for how many years? 3 years. So now we move there. So we can say year items, yes, items.
This call will need 3 minutes, sir.
Okay, that's fine. Okay, let me quickly create another link so that we can join. Thank you.